Stocks keep hitting new highs every month. We had stocks on fire in September, and the start in October is very strong outside of today as well. So, what should you be doing? Should you be buying or selling? And what if you never got any exposure to some of the hottest industries, including AI and crypto and gold, which are not even offered in most retirement plans? How can you actually invest in them easily and effortlessly and maybe even avoid capital gains taxes? All this and more, including where interest rates are headed, how that impacts stocks, whether or not we're going to have a Santa rally in today's free video conference. It is Natalie Pace, and I encourage you to share this video conference with your friends. Let's form a powerful, enlightened investor community. Thank you again for your time, for your support. Email info@nataliepace.com if you'd like to join us live at our next one, or get on our mailing list so that you're sure to get my weekly blogs, which are free as well. And I do encourage you to join us this weekend for our last financial freedom retreat of the year and our fixed income without paper losses masterclass, which is the following Saturday. So October 11th through 13, financial freedom retreat. Complete money makeover. It's going to change your life. And in addition to that, you'll learn how to save thousands annually in your budget. And then on the following Saturday, October 18th, we're going to have a fixed income without paper losses. Those paper losses are far more problematic than you are being informed. And we're very happy to report that the people who have been using our fixed income strategies for more than a decade, no paper losses, at market or well above market in terms of the income that you can get. All right, we'll get started in just a moment. Okay, so let's start with AI and then move into air taxis. So AI is on fire, and as someone who uses it, it's super impressive, but it's also a big energy drain. So that's actually positive for clean energy, and it's negative for some of their profitability. Although we have seen really strong profitability in NVIDIA. The thing is, it's pretty much priced in. So I just want to encourage you guys to go ahead and read my Magnificent Seven update, which basically tells you that it's on fire, it's very expensive, and for most people, it's going to be a better idea in order to manage volatility to have the Magnificent Seven or an AI fund instead of just NVIDIA. You know, we saw this big news on AMD, and if you were just invested in NVIDIA, you don't participate in the great gains of AMD. Whereas if you have ARTY, which is the iShares artificial intelligence, or even TechB, TECB, another iShares that's focused on breakthrough technology, then you are going to be exposed to that. So, and it helps because you have more than one company, you don't have to babysit it. So for most people, that is going to be a more appropriate option. Also, I want to remind you, and we're going to be stressing this, that rebalancing is a very important thing to do once, twice, or three times a year. You don't say, it's high, should I sell? Should I sell? It's low, oh no, is it going to go lower? Should I sell low? And that's what a lot of people do, is that they are watching the price and they're letting their emotions drive the car. And that is a recipe for a disaster in investing. If you want to be a professional investor who actually can get on the right side of the trade, you have to treat it more like a professional athlete, right? You don't go up to the place hoping and praying or using your emotions. You go up to the plate knowing that you've done your research and knowing that you have really set up a plan that works, and you execute that strategy. Now, we do have that time-proven 21st century plan that has worked since 1999. It's easy as a pie chart, and I'm absolutely encouraging everybody to make sure we have free web apps. You can personalize your own pie chart. That helps you to understand, do you have, and especially, you know, look, if you invested in Bitcoin a number of years ago, maybe that's too much of your portfolio now. And instead of having to live through a crypto winter where you lose half of your wealth, capture gains. It's not all, it's not nothing. So that's the big theme here. Also, I want to remind you that when you're using your emotions, you're not going to be on the right side of the trade because so many people on April 8th, you could have bought Nvidia for under $100 a share. And now you're going to have to buy it at an all-time high. Now, in April 8th, people were so worried about tariffs that many people were selling. So remember that that kind of volatility is managed when you have that time-proven pie chart strategy that you rebalance once, twice, or three times a year. Do I think now would be a really good time to rebalance? Yes, stocks are at an all-time high, so it would be a great idea. Part of the reason for that is that the Santa rally is not a given. It's a probability, but it's not a given. And I do want to talk about air taxis in just a moment. But before I jump into air taxis, I want to talk a little bit about interest rates because people are like, oh, well, interest rates are getting cut. That's going to be good for the economy, right? And it's more complicated than that. Interest rates are being cut because the unemployment is rising. That means more people are out of work and can't afford to buy things. So the reason that interest rates get cut is that the economy is actually weakening, right? So it gets cut to try to boost the economy. And that's why most of the time in the early stages of those interest rate cuts, when unemployment is rising, stocks are actually going to go down. So it's not a given that interest rate cuts are going to make them go up immediately. It usually takes a while for that to be the case. So that's why I'm saying is that don't Santa rallies are pretty reliable, but when they're not reliable, they can be terrible. So now would be a great time. You can rebalance again at the end of December if we have a Santa rally. Okay, let's jump into air taxis. This is a very exciting area, and I have an air taxi blog that I do encourage you to read. It's called Flying Cars Have Already Arrived. Archer Aviation has been selected as the air taxi for the LA Olympics. So when I wrote this blog originally, and this is in European time, so it's day, month, year, not, we don't have a 26th month, right? So it was written on May 26th. Now, at the time, I was saying, I'm going to try and see if I can get a better price. Before I actually purchased it myself, I sent out on social and on email saying, okay, I am going in. And that was around $9 a share. Now it's up a little bit. This is a company that is still cash negative and very early stage. What that means is that it's going to be high risk, right? And honestly, for those of you who do not know how to evaluate stocks and are not on with individual stocks, you have to buy low, sell high. It's a different strategy. With early stage, even though, air taxis may eventually take the place of helicopters and become this, very, very large multi-billion dollar industry, right now, if we hit a recession, even if they are the wave of the future, they can get drugged down. So good companies, like even Google was drugged down in the dot-com recession. And then, of course, it went on to become, trillion-dollar company. But during that period of the recession for 2 years, you don't want to lose a great deal of your wealth. So you want to make sure that you understand buy low, sell high if you are going to invest in individual companies and early stage, cash negative, very young, small cap companies like Archer. It's really high risk, okay? But I did go ahead and jump in and it's doing pretty well. So the reason that I jumped in now is that the current White House administration is fast tracking this technology. They really want to see this. So do, by the way, anybody who has to drive to the airport in gridlock traffic, and that includes a lot of cities, and that not just in the U.S., around the world. So Archer has projects literally around the world, Japan, Abu Dhabi, and a lot of other places where they're like, look, our people cannot get to the airport on time. I wish, New Delhi needs it as well. So there's some pretty exciting things that are going on here and partnerships, and it is expected to get some sort of FAA approval within a 12-month period that actually started a few months ago. So I think that if you are interested in something like this, you're really balancing or juggling a lot of balls here because we aren't guaranteed that stocks go up, and when stocks go down, they drag down good companies with them. But on the other hand, we aren't guaranteed that Archer won't have a flying car crash or an air taxi crash or something else that might really set it back. So it is very high risk, but I did go ahead and jump in on that. Now, I also want to talk a little bit about Bitcoin and gold, specifically for those of you that have a 401k or an employer-sponsored plan. This is one of the reasons why I don't put all of my money in my employer-sponsored plan. I would put it in up to the match because you just don't have the choice to invest in Bitcoin or in crypto or any of these other AI. You can't get a targeted AI fund either. But if you do it up to the match, so that you're getting the free money, maybe that's going to be your large caps. It can be a piece of the puzzle. Maybe it's going to be some of your safe side. And then do your own health savings account, especially if you're healthy and spending an arm and a leg on health insurance. If you need more information on that, email info@nataliepace.com for our health savings account blog. It's also mentioned in the ABCs of Money. Be sure you're getting the 6th edition. So go to nataliepace.com and click on that book cover to be sure you're getting the 6th edition. But in addition to that, open up your own Roth IRA. I always put my HOTS in my Roth. Many reasons for that. No capital gains taxes is one of the big ones. So now you actually can invest in an Ethereum or a Bitcoin trust within a Roth IRA very easily. And that's something that I would consider doing if I were you. That way, two things are happening. First thing is you are not going to pay capital gains if you do capture your gains, right? And in fact, if it shoots the moon, you're not going to have to pay income taxes when you pull it out. Peter Thiel is reportedly got over $5 billion in his Roth IRA. So I would just strongly suggest that you think about having not just everything in one account, especially where the options are very limited. Also, consider now that that you might want to get tax protected instead of just having that crypto wallet. The other problem with the crypto wallet is that a lot of people are not capturing their gains at the high. And then when they enter the crypto winters, you're having a long period of time where your net worth has plummeted, your spirits have plummeted, your FICO score is plummeted, and you got to endure whether it's 18 or 24 months before you come back and feel like you're king of the hill again. You could capture those gains, and when the price plunges, you can buy more low. So you can always be increasing your wealth instead of, whoa, oh no, right? That roller coaster ride is not only really bad for your mental health and your stomach health, it's really bad for your fiscal health and your FICO score and all the other things that you're depending on. So let's talk a little bit about which sectors are strong and which sectors are money pits. And I do have another blog that I'm going to refer you to. I think it's this one here. Is it the Magnificent Seven blog? Hang on. I believe it's this one. So I was basically looking at various sectors, right? So here is the sector performance. And this is as of September 19th, so a couple of weeks ago. So silver's on fire. It's even higher than Bitcoin and gold, right? And copper is even higher than Bitcoin and gold. And that's one EPU is something that we have been using in our sample pie charts for many years now, and copper's on fire. There are many reasons for that. And you can see here at the bottom, energy, healthcare, and consume. So the retail apocalypse and real estate, along with healthcare and energy, are the sectors that are not doing as well. Again, if you are getting your size and style, so large, medium, small, value, and growth, and adding in the HOTS, then you could actually be underweighting those things that are not working as well. We're actually using value fund replacements And that's helping us to get a better income, so a better dividend, as well as higher credit quality and also country diversity. So that's the way that we are underweighting those industries that are not doing well. And by the way, we've been doing that for a couple of years as well. And in the hots, we are leaning into those areas that are doing great. Silver has been one of our hot choices. Copper in our Peru has been one of our value fund replacements. Um, crypto, either Bitcoin or Ethereum. And in fact, our Ethereum ETF, that one tripled since April. So again, it's a reminder that these can be very volatile, right? So here is a chart there we go, of Ethereum over the last year. So you can see here that Ethereum went way down on April 8th. And that's when stocks went way down, right? So it went all the way down here to 1386. So 1390. It's at 4369. Our Ethereum ETF tripled. So again, it's really, really important to think about capturing gains, right? And having that strategy once, twice, or three times a year, it's going to help you to be on the right side of the trade. Okay, we talked about that in the money pits. Tesla, Magnificent Seven. I got a lot of questions about people saying, oh, should I be capturing my gains on Tesla and the Magnificent Seven? I just want to remind everybody that when you rebalance, you want to start by making sure that you have two pie charts. One is the pie chart of what you do have, and the other is the pie chart of what you should have. And that pie chart will tell you, okay, if you're supposed to have 10,000 in this slice and you have 20,000, sell one of the slices high, unless you want to have two slices of hots, right? So I just want to remind people of that. It's not looking on the brokerage statement and deciding, should I buy or should I sell? It's looking at the complete picture that's going to include multiple accounts. That's why you have to create your own holdings pie chart using some sort of file like either Pages or an Excel file, because you're also going to be including your safe money, which you might have in certificates of deposits or treasury bills, or even in your checking account at the bank. So remember that we do have a rebalancing IQ test blog, email info@nataliepace.com if you would like that. Um, Okay. Oh, I do want to talk a little bit about fixed income without paper losses. We are going to host a special masterclass on October 18th. It's a Saturday online, so you can attend from anywhere. And our fixed income strategies, which we've been, you always have your at-risk side in stocks or equities and your safe side that is not supposed to lose money. It's not supposed to have paper losses. So if you are being sold into things that have paper losses, and then being told not to worry because you can hold it to term, my guess is you are not looking at the fine print, because those paper losses are reducing the income that you're earning, or maybe even making you lose money completely. And a lot of times the term is much longer than you're going to live. So it's really important to be the boss of your money, to know what you own. Our fixed income strategy is not suffering from paper losses, and is performing at the top of the yield, and in some cases blowing the yield out of the water. So do join us for that. The prerequisite is that you must have attended the Financial Freedom Retreat. And that's this weekend, starting on Saturday. Monday's a national holiday, online, so you can attend from anywhere. Email info@nataliepace.com if you would like to join us. All right, so one last thing I want to talk about are Wall Street valuations, because that's why the stocks keep pulling back. And by the way, that's why they dropped so much in April. So we hear about tariffs, and Nvidia drops down to under $100 a share. In fact, all of the Magnificent Seven dropped much further than the average S&P 500 index. And that was down 20% from the February highs to the low on April 8th. So it's really important for you to make sure that you're not just riding a Wall Street roller coaster, but also understand that the reason for this very wild swings And the massive drops in a very short period of time is because stocks are very expensive. It's not because we don't think AI is going to be doing great things tomorrow or that the world is going to stop using AI or technology. It's that they're overpriced. And that's something I do mention in that, Magnificent Seven update blog that I just posted. So here's what overpriced looks like. And I believe I have that chart up behind this one, if I'm not mistaken. So as you can see in this chart, this is the CAPE ratio by Nobel Prize winning economist Robert Shiller. And our current price earnings ratio, and again, it's just a gauge of measuring how expensive stocks are, right? Based on price to earnings, like how much more expensive is the price than the actual earnings of the company. Um, and so by the price earnings ratio, the only time in history when stocks have been more expensive was the dot-com recession. They're more expensive than the Great Depression in 1929 and the Great Recession in 2007. And that's why we're experiencing the volatility. That's why I'm encouraging everybody to be the boss of the money. And that's why I'm encouraging rebalancing at least 3 times a year. Now is a fantastic time. You always want to fix the roof while the sun is shining. You do not want to wait for the economic storm to completely wipe out your gains for you to start fixing things. It's human nature. Fix things when they're broken. I strongly recommend that you check into it right now. Okay, I'm going to answer a few questions that were emailed in by our volunteers. Again, volunteers are encouraged to email us their questions. I'm happy to answer them. One was a question about callable CDs. So when you're purchasing any fixed income product, and again, we're going to go over this in greater depth on day 3 of the Financial Freedom Retreat, and then in the masterclass the following Saturday. The mantra is this: keep the terms short and the creditworthiness high. These are the most important mantra of the fixed income side. However, people are saying, okay, let's say I keep a short-term CD from one of the A or double A rated banks, and it says in the fine print that it's a callable. What that means is if the interest rates get cut, they can actually say, okay, I'm sorry, we're going to give you your money back. We'll give you the interest you earned up to this point. That's what that means, right? So some broker salesmen are saying, well, maybe you should just invest in treasury bills then. That way you're going to get the yield. The only thing I would say is this: in addition to keep the term short and the creditworthiness high, you have to observe FDIC insured levels, and I would not put all my eggs in one basket. So I would not put all my eggs just in treasury bills. We are seeing a little tighter liquidity there. I would not put all my eggs in one CD. In fact, the federal FDIC insured levels are per bank, not per account. So again, there's a lot of fine print. That's why we spend one full day on it at the retreat and why we need a master class in addition to that. Okay, one other one was on First Majestic Silver, which is an individual company that I featured when I talked about silver. And if we go over there, she was like, look, this one's way up from when we purchased it because we were featuring this one this year. Obviously, over the 5-year period, it's come back a little bit, but we featured it when it was pretty low. And she said, like, wow, I've made some really great gains. Should I be selling it now? And the thing to remember about all the safe havens is that if stocks go down in the beginning of it, they can get drugged down too. And there will come a point where they decouple and people will lose faith in stocks and they might say silver's where it's at. The reason that I liked First Majestic is that they actually mint silver coins and they do these collectible coins that people might find very popular. So that's why I liked it a lot. It also had very, very robust year-over-year sales growth that was really above the industry standard. So I do like it, but it's an individual company. It's a smaller company that increases the risk, and that is a buy low, sell high product. But again, I think you can do even on the individual company side where it is more buy low, sell high rather than just rebalancing. I think that you can have a bit of both, right? Like if it is really really high and it's doubled, You could take some of the gains off the table in case it gets drugged down if stocks go down. And then the last one was about capture gains on Tesla or Magnificent Seven. I already did talk about this, but what I want to say is, again, stressing this. You must mock up a pie chart of what you have. You must mock up a pie chart of what you should have. When you do that, the pie chart tells you what to do. It says, okay, if your slice is supposed to be this big and it's this big, you need to sell high and trim it back to where it should be. If your slice is this big and it's an industry like clean energy that you think might actually be the wave of the future, then you buy low. So it is a buy low, sell high system on autopilot, takes the emotions out of it. All right, I'm going to stop the video conference here. Remember, when you're a volunteer, then you get to email us your questions, and I will do my best to answer them in one of our video conferences. And I do encourage you to join us this weekend. It's absolutely life transformational because we teach you also how to save a lot of money, thousands for most people, tens of thousands for some people in your budget. Most people are getting the price of the retreat bargain within a few months in budget savings alone. And of course, if we can save your nest egg and help you to invest in hot industries, that's going to be a game changer for the rest of your life. So again, info@nataliepace.com. Let me show you how you can learn more about our retreat, including where you can get testimonials. It's going to be 8 to 4 Pacific, 11 to 7 Eastern online. You can attend from anywhere. You can call or email to register. We can either send you a PayPal invoice or take a credit card over the phone. You can bring someone with you for half off. So there's a lot of things. There's a lot of testimonials there. The pricing information is there. The things that you're going to learn are there. So lots of information. And again, that's just go to nataliepace.com and click on the big orange Financial Freedom Retreat flyer. You can access our book there. You can follow me on social media. If you are investing in individual companies, be sure you're following me on social media because, as I did with Archer, when I went in, I post on social media before I buy. And I also try to do the same thing when I sell as well. I try to tell you first before I do it. All right, so thanks again for joining me, and I look forward to those of you who are joining me this weekend on Saturday. I'll see you bright and early at 8 a.m. Goodbye now.